Market corrections, often defined as a decline of 10% or more in stock prices from their recent highs, are inevitable events in the world of investing. While they may cause panic and uncertainty, history shows that market corrections also present valuable lessons for investors. Let's look at the top 10 market corrections in U.S. history and the lessons we can learn from them. 1. The 1929 stock market crash. One of the most infamous corrections in U.S. history occurred in 1929, leading to the Great Depression. The market lost nearly 90% of its value from its peak. This event teaches us the importance of avoiding speculative bubbles and the risks of over-leveraging. Long-term investing, proper research, and staying diversified are key takeaways from this crash. 2. The 1987 Black Monday crash. In 1987, the stock market suffered a sudden and sharp drop, with the Dow Jones Industrial Average losing over 22% of its value in a single day. This correction highlighted the importance of understanding market psychology and the impact of sudden shocks. It taught investors to be prepared for unforeseen events and to avoid making rash decisions based on panic. 3. The dot-com bubble burst, 2000. The dot-com bubble of the late 1990s led to a market correction in 2000, when technology stocks, particularly in the internet sector, collapsed. Many investors who bought into these overvalued stocks saw massive losses. The lesson here is to evaluate investments based on fundamentals and not get caught up in hype or speculation, particularly with emerging technologies. 4. The 2008 financial crisis. The 2008 financial crisis was triggered by the collapse of the housing market and the subsequent downfall of major financial institutions. The stock market lost nearly 50% of its value from its peak. This event taught investors about the dangers of excessive risk-taking, the importance of liquidity, and the need to stay diversified, especially in times of economic uncertainty. 5. The 2011 debt ceiling crisis. In 2011, the U.S. faced a debt ceiling crisis that led to fears of a government default. This caused a 10% drop in stock prices over a few weeks. The lesson from this correction is the importance of monitoring political events that can cause short-term volatility and impact market sentiment. A diversified portfolio can help weather such risks. 6. The 2015 China stock market crash. In 2015, the Chinese stock market experienced a massive correction that sent ripples across global markets. It triggered a global sell-off with the S&P 500 losing about 12%. This correction emphasized the importance of keeping an eye on global events and understanding how foreign markets impact the U.S. economy. Investors must stay informed about international economic developments. 7. The 2018 market correction. In 2018, fears of an economic slowdown and trade war between the U.S. and China led to a market correction. The S&P 500 fell by about 19%. This correction highlighted how external geopolitical tensions can affect market stability. The lesson here is the importance of emotional control during market volatility and focusing on long-term goals rather than short-term news. 8. The COVID-19 crash, 2020. In 2020, the global pandemic caused a massive sell-off, with the market dropping by over 30% in a matter of weeks. This event teaches investors the importance of staying calm during extreme market volatility. It also highlights the importance of emergency funds and the need to stay flexible with investment strategies during unexpected global events. 9. The 2022 bear market. The 2022 bear market was driven by a combination of high inflation rates, aggressive interest rate hikes by the Federal Reserve, and global geopolitical tensions. This correction saw the S&P 500 drop by more than 20%. The key lesson from this correction is the importance of risk management and adjusting your portfolio to mitigate potential losses in the face of rising inflation and tightening monetary policy. 10. The 2023 market correction. In 2023, inflationary concerns, rising interest rates, and global economic uncertainty caused another correction. Stock prices fell by over 10% during the year. The main takeaway from this event is the importance of having a diversified portfolio and regularly rebalancing it to adapt to shifting market conditions. Understanding your investment goals and risk tolerance can help you navigate periods of uncertainty. Each market correction throughout U.S. history has offered valuable insights for investors. They remind us of the importance of diversification, patience, and the ability to stay calm during market downturns. While corrections are a normal part of investing, they can be opportunities to learn from past mistakes and implement strategies that protect your investments in the future.